Right now, across the United States, we are facing an affordability crisis. For example, since the pandemic, the home prices in Nebraska are up 41.8%. For example, in April of 2020, the median sale price of a home in the Omaha area was $221,513. 4 years later, in April of 2024, the median sale price of a home in the Omaha area was $315,000. Many buyers right now are priced out of the market. Does that mean we're in a housing bubble? Are home prices going to crash? How much home can you afford to purchase in today's market? We will also answer the question, when should I buy a home? Those are the questions we're going to answer in today's video, and we're going to get started right now. If you're buying a home, in order to have a home within your budget, many experts agree your housing costs should not exceed 28% of your gross monthly income. When you make a house payment, your payment consists of PITI, which means principal, interest, taxes, and insurance. And if you have less than 20% down payment, some mortgages will require mortgage insurance. Mortgage insurance is paid by the borrower to protect the lender. Depending on the borrower and the amount of the loan, this can be a few $100s added to your house payment. When you buy a home, one of the first calls you should make is to a lender to get pre-approved. Now, just because the lender says you can get pre-approved for a $400,000 loan doesn't mean you should go out and buy a $400,000 home. Your lender is going to approve you for a maximum purchase price. This does not mean you can comfortably afford a $400,000 home. You want to stay within your budget. We all know inflation is driving the price of everything higher. That means your insurance and your property taxes are likely to go higher in the future. Make sure you plan accordingly. One of the mistakes buyers make is not anticipating the cost of repairs. If you're buying a home, there's going to be maintenance costs. Make sure that's in your budget. When you purchase, make sure you do your due diligence. Do your inspections, especially if you're buying an older home. Also, if you're buying an older home, make sure you do a sewer scope inspection. Trust me, it's going to be the best $250 you'll ever spend. Let's do some math. Let's say you make $75,000 a year before taxes. First, we need to calculate your gross monthly income. Gross means before taxes are taken out. So you take $75,000, divide that by 12, is $6,250 per month. Out of that $6,250 a month, you multiply by 0.28, which gives you $1,750. That means your principal, interest, taxes, and insurance cannot exceed $1,750 for a monthly payment. In order to make this work, we're going to need to make some assumptions for taxes and insurance. Property taxes are going to vary from property to property. When you're buying a home, there's two questions you should always ask. Number one, how much are the property taxes? And two, how old is the roof? The age and condition of the roof are going to play a role in the amount you pay in homeowners insurance. The cost of a homeowner's insurance policy is going to vary from person to person. Believe it or not, your credit score can affect the amount you pay for insurance. So you always want to take care of your credit, because if you have bad credit, you're going to pay more in insurance. When we do these calculations, we're also going to assume you're coming in with a 20% down payment. Let's say you have a household income of $75,000. How much can you afford to purchase with a household income of $75,000? Our total payment of principal, interest, taxes, and insurance cannot exceed $1,750 if we want to stay around that 28% of our gross monthly income. So we have some assumptions. We have a 20% down payment. Our property taxes are $3,720 a year, or $310 a month. Your insurance is going to be a little over $2,500 a year, or $216 per month. Now, at a 7% interest rate, we can afford to purchase a $229,000 home. At a 6% interest rate, you can afford to buy a $255,000 home. And at a 5% interest rate, you can afford a $285,000 home. So as interest rates decrease, our buying power increases. As interest rates decrease, a buyer can afford to buy more home. Let's say we now have a household income of $100,000. How much can we afford to purchase? So our target payment is going to be $2,333. Again, with the same assumptions, 20% down payment. We're bumping up a little bit in price, so our property taxes are going to be a little bit higher. Our homeowner's insurance is going to be a little bit higher too. So we're looking at $440 a month in property taxes, and in insurance, we're looking at $234 per month. Now, at a 7% interest rate, we can afford a $311,000 home. At a 6% interest rate, we can afford a $345,000 home. And at a 5% interest rate, we can afford a $386,000 home. What if we make $125,000 a year for a household income? How much can we afford to buy? Now, our total payment target is going to be $2,916. Again, with the assumption of a 20% down payment, our property taxes, we're buying a little bit bigger home. We're going to have a little bit more in property taxes. They're going to be about $500 a month. Our insurance, we got a little bit bigger home to insure, so it's going to be a little bit more. We're looking at $258 per month. Now, at a 7% interest rate, we can afford to purchase a $405,000 home. At a 6% interest rate, we can afford a $449,000 home. And at a 5% interest rate, we can afford $502,000. What if rates were back to the lows of the pandemic? A few years ago, interest rates were at all-time record lows. How much home could you afford if we had a 3% mortgage interest rate? If we had $125,000 a year household income, we came in with a 20% down payment, and we had a 3% mortgage interest rate. At a 3% rate, we could afford to purchase a $639,000 home. Now, are rates ever going to go back to 3%? Chances are not in your lifetime. Too many people focus on price when they look at affordability. Affordability is all about terms. When you have really low interest rates, homes become more affordable. So many buyers bought during the pandemic when rates were at all-time lows, prices skyrocketed. At the time, we had three factors that drove prices. Number one, we had record low interest rates. Two, we had record low inventory. After the GFC, we had fewer builders building. Builders were more cautious about building a home unless they had a buyer under contract for that home. Number three, during the pandemic, we had lumber mills shut down. We had supply chain disruptions. That caused builders to hit the pause button, meaning there was only existing homes to purchase. So builders weren't building. That drove prices higher. The fourth thing, we had more buyers at peak buying age. The biggest segment of the population was approaching peak buying age. This graph shows the population of Omaha, and it shows the largest segment of the population is approaching their mid-30s. This fuels demand. Now that prices have skyrocketed, will prices come back down? Now, nobody knows for sure. Now, remember, real estate is like the weather. Everything is local. Until you have way more supply than demand, prices are not going to come down. Prices have gone up, interest rates have gone up. This has cooled demand. Fewer buyers can buy. One of the solutions to the affordability crisis proposed by the Biden administration is the idea of a $25,000 credit for first-time home buyers. Now, this is a bad idea. And why is that? Well, this is going to increase the number of buyers. So when you increase the number of buyers and you haven't increased the supply of homes, what is that going to do to prices? Prices are going to go up. When someone is living in a home, they typically have to sell in order to buy a new home. For a first-time home buyer, when that buyer buys a home for the very first time, they're taking a home out of inventory. The first-time buyer typically buys a lower-priced existing home. The only way to add more inventory right now is to build a new home. And typically, new construction tends to be higher in price and out of reach of many first-time home buyers. We have seen the cost of everything go up. That's inflation. When people are paying more for gas, groceries, and household goods, that means there's less money available for a higher house payment. Wages have not kept up with inflation, so you pay more for groceries, but you're not making more money to go out there and buy a new home. Now, when this happens, the economy tends to slow down, which eventually leads towards a recession. Right now, we have a frozen market with existing homeowners. They would like to sell, but they don't want to give up a 3% interest rate to turn around and buy a higher priced home at a 7% interest rate. In order for a crash to occur, supply has to be greater than demand. We have less demand, but we still have low supply, especially in the lower price points. Inventory is increasing and demand is cooling, but that doesn't necessarily mean we're in crash territory. Back during the GFC in the Omaha market, prices did not tank. We had plenty of inventory, but we didn't see prices go down like other markets. And it took longer for a home to sell. Every real estate market is going to behave differently. Austin, Texas is going to be different from Omaha, Nebraska. Some people have the idea, well, prices have gone up so much, the average person cannot buy a home, so prices have to come down. And that's simply not the case. And when you drive around town, what do you see? You see apartment building after apartment building, especially in some really, really nice areas. The rich have figured this out. They have built a ton of apartment buildings. All of these people need a home, and they need to live somewhere. If they can't afford to buy a home, then they're going to be stuck renting. And that's why you see all of these apartment buildings. Can builders build a smaller home? That would help, but builders need to make money. In our market, just to get ground developed to where you can build a home on it, that's going to run you about $100,000. Back in the day, a developer could get 4 to 5 homes per acre. Now, that very same developer, because of regulation, can only get 2 to 3 homes per acre. That's driving up the price of land. About 25% of the cost of a new build is regulation. When a builder is waiting for plans to be approved, that waiting is costing the builder money, which is driving up the price. Are prices coming down? You might see prices come down in some of the higher price points, and we see a little bit of that right now with new construction. Some builders have reduced prices, but will it be a fire sale? No. Will some markets cool off? And will prices come down? Yes. But that doesn't mean we'll see another 2008. In the early 1980s, we had interest rates spike to 18%, and we had a very strong recession. Yet home prices did not drastically decrease. Why didn't prices come down when interest rates spiked to 18%? Well, that's because the baby boomers after World War II was the largest segment of the population. And in the 1980s, baby boomers were at peak buying age, which helped maintain demand. If we have a recession, will we see a spike in foreclosures? Probably not. In order to have a foreclosure, a buyer must be in a negative equity position. If prices have gone up and a homeowner loses their job during a recession, that homeowner can simply sell on the open market and pocket the equity instead of having the bank take back the property. When should you buy a home? Now, you should buy a home when you're ready. The perfect home doesn't exist. The perfect time to buy a home doesn't exist either. You should buy a home you can afford when it makes sense for your family. And you should plan on living in it for at least 5 years. Now, if you're relocating, it's okay to rent first. Try it out for a year. Learn the market. Find out what you like to do, where you like to hang out. Then, if things work out, then go ahead and buy. And speaking of relocation, if you're relocating to Omaha, Nebraska, and you need assistance, my contact information is in the description below.